Question?
I have just one question. You mentioned the GRAP or the intentional
Defective grantor trust. How do you choose between the two?
Yeah, I know one provides income, the other you have to worry about gift taxing, but.
No, both can operate very similarly so that there's no gift tax. An intentionally defective grantor trust is merely a sale of an interest to a trust that is disregarded for income tax purposes because you are treated as the owner of the trust that you've created. It's known as a grantor trust. So all the income gets reported on your tax return. That's why they call it a defective grantor trust, intentionally defective. But for estate tax purposes, it's extremely valuable. So just like a GRAP, we're moving future appreciation above and beyond the sale price, because we're going to get the sale price back in the form of note payments in an intentionally defective grantor trust. We're going to get note payments back. And there's no gift tax, supposedly, on the initial transfer, no use of the exemption on the initial transfer. But the difference is that the intentionally defective grantor trust structure is not officially sanctioned or approved by the IRS and regulations, whereas a GRAP is. It also gives some additional tax benefits in the sense that an intentionally defective grantor trust, instead of the 75-20 rate, which you have to use in a GRAP, which is a higher rate of interest, you can use the actual applicable federal rate. So if it's a 9-year note that you're taking back in an intentionally defective grantor trust, the interest rate is 20% lower. You can do a balloon note instead of having to take out an annual annuity that's sort of like getting an amortized note. So there's different structures, and there's cautions and things that you have to do to prepare yourself in the event of an IRS challenge in the case of a sale to an intentionally defective grantor trust. You can also gift to an intentionally defective grantor trust, but then there is going to be a use of the exemption.
Yeah.
And so some clients they want to preserve that exemption. It's $5,450,000 today. It's valuable. It's indexed for inflation right now. If the Republicans take over the presidency and the Congress, it'll probably be repealed. The estate tax will probably be repealed. Wouldn't be surprised. On the other hand, highly likely that that's not going to happen, and so we'll have this $5,450,000 going forward. If the Democrats take control, they're going to reverse a lot of these things. They're going to reduce the gift tax exemption back down to $1 million, which is what they threatened doing, and reduce the estate tax exemption down to $3.5 million. So how do you plan for that? You can't. You can't predict it. You're just trying to take advantage of what you can take advantage of today based on what you know today. But there, again, no one size fits all. If I have a client who's getting ready to sell a business, and we know that it would appraise for this, but it's worth this, then using one of these techniques is extremely valuable. And in our client's case, 2 years later, it would have been worth a fortune. It would have been worth a fortune. But we didn't wait. And he didn't want to deal with it again. He should have.
You're talking about a lot of issues where family wasn't involved in the business and kind of the management succession plan and that kind of thing. I'm just curious, and there's pros and cons to them, but are you seeing a lot of ESOPs used these days?
I'm getting a lot of questions about ESOPs. But when you start digging into what an ESOP really is and what it entails, people come in, they look at it, and then they back away. An ESOP will work well in a situation where you've got a business that is growing, that is generating significant cash flow, and that has an extremely strong management team. If you have all those components, an ESOP will work well, and it can work. If you don't, if you're missing one of those components, an ESOP is a recipe for, not disaster, but it's just not, it's not going to be efficient. It's going to be expensive, and it entails annual compliance, annual valuations, and it's restrictive. When you go to sell the business with an ESOP involved, you'd be amazed, but there are so many restrictions that are imposed so that the ESOP is elevated almost as if it were the majority shareholder and not And we've had a situation like that with one of our clients. So, I mean, again, it really depends on the facts. I like ESOPs for what they are, but it really is, it depends on the facts. You've got to have growth in the business, cash flow, and a very strong management team.
And an entrepreneur.
I think a strong a management team probably needs to be entrepreneurial, but not to the point where they're crazy entrepreneurial. They need to be able to manage the company into the next level. So if they're like the original entrepreneur who's always taking risks and may not necessarily succeed, so entrepreneurial is being able to take risks, but also measured risk. That's a good point. Question?
And adding to that, it adds to the complication of the seller's reinvestment as well if they want to further gain.
So in an ESOP, you can sell a piece of your company to the ESOP now and defer the future, which then you're now bringing in an outsider usually to act as a trustee. Some people will say here, oh, you don't have to do that. You could be the trustee of your own ESOP. And that's where you get into breach of fiduciary duty issues and litigation that I've seen more oftentimes than not. So you want to be very careful about that. But also in an ESOP, if you have a C corporation, you can actually take the entire amount that you received from the sale of your stock and roll it over into publicly traded securities and defer the gain until you dispose of those publicly traded securities. So there's lots of techniques that we can use using leverage, S corps, C corps. Very, very interesting from a tax perspective, but not always the right answer. Not always the right answer. I've got one client that used an ESOP that very unhappy that they did it.
Pretty tough to unwind too.
Extremely tough to unwind, and I've seen people try to do it in a way that hurts the employees and the participants in the ESOP, and that's when you get a lawsuit, and no one wins except the lawyers in the lawsuit. What other questions on business succession planning, estate planning for business owners you may have run into? Well, thank you for coming today. Session 4 is now over. Come back in September for Session 5, Advanced Estate Planning, and then we'll have the final session in October, I believe. So